closer and you see signs like this: retail space for lease.
It's not a good story, it's not a pleasant story, but it's the reality that we have to live with.
Position where people are not going to be able to buy houses. It's going to hurt mortgage brokers. It's going to hurt bankers. It's going to hurt realtors. Really hurt people. And I think what the situation was, people were not ready for this.
Decades of free money, the day of reckoning is coming, as we're seeing with the financial meltdown across the board. There's $1.5 trillion of commercial real estate loans that are coming due.
Hello, and welcome to this episode where we will be discussing the possibility of a market crash. In this episode, we will look at Warren Buffett's warning about the next property market crash. Are we in a property bubble? How does the current housing market differ from the housing market crash of 2008? What is the significance of bank failure? Are we heading for a recession? And finally, my conclusion. You're watching the Business Broadcasting Channel. Warren Buffett, the renowned investor and CEO of Berkshire Hathaway, has a dire warning for those who are investing in the property market. Be cautious, as the next property market crash could be on the horizon. Buffett, who has a long track record of successful investment, has been vocal about his concerns regarding the property market for a while now. He believes that the market is overvalued and that prices are being driven up by low interest rates and a lack of supply. In a recent interview with CNBC, Buffett stated, "I don't know when the next housing downturn will come, but I do know that at some point it will come." He went on to explain that he has seen this cycle before, where people get too optimistic about the housing market. Prices skyrocket and then a crash ensues. Buffett's warning comes at a time when the property market is experiencing record high prices and an unprecedented surge in demand. Low interest rates, coupled with a pandemic-induced desire for more spacious living, have fueled the demand for homes, resulting in bidding wars and skyrocketing prices. However, Buffett cautions that this trend is not sustainable and a correction is due. He believes that investors should approach the property market with caution and focus on the long-term outlook rather than short-term gains.
I just read and read and read. I probably read 5 and 6 hours a day. I don't read as fast.
Buffett famously warned of the 2008 financial crisis and even went on to profit from it by investing in undervalued companies. As Buffett himself said,
"You don't find out who's been swimming naked until the tide goes out."
are we in a property bubble? The current state of the housing market has raised concern about whether we are in the housing bubble. The pandemic-induced desire for more spacious living, coupled with low interest rates, has fueled the surge in demand for homes, resulting in record high prices. According to home sale price data from Redfin, home price growth was in double digits year over year every month from August 2020 through mid-July 2022. However, signs of a slowing housing bubble emerged throughout the rest of 2022 and into the first weeks of 2023. House prices continued to decline month over month during that time, and median house prices on a national scale are experiencing minor year-over-year decreases. House prices continued to decline month over month during that time. According to Redfin, the median house price in the US between March 20 and April 16 was $366,000, a 2.7% decline compared with the same time period in 2022. While some experts believe that the current state of the housing market resembles the definition of a housing bubble, others argue that the surge in demand is different from previous bubbles, as it is driven by a fundamental need for more space and a lack of supply. It is important to note that the housing market is cyclical and a correction is inevitable. However, whether or not we are currently in a housing bubble remains a topic of debate amongst experts. The housing market's rapid growth during the COVID-19 pandemic has raised concerns about whether we are in a housing bubble. While signs of a slowdown have emerged, it is still unclear whether we are in a bubble or experiencing a fundamental shift in demand. How does the current housing market differ from the housing market crash of 2008? The 2008 housing market crash was caused by a combination of factors, including risky lending practices, a lack of regulation, and a surge in subprime mortgages. As a result, the crash led to widespread financial crisis and affected the global economy. Today's housing market differs in several ways from the conditions that led to the 2008 crash. Some of the key differences include: 1. Tighter lending standards. After the 2008 crash, lending standards were tightened significantly to prevent risky lending practices. As a result, lenders today are required to verify income and employment status, and they typically require a larger down payment than they did in the past. 2. Less risky mortgages. The subprime mortgages that contributed to the 2008 crash are much less common today. While there are still some high-risk mortgage products available, they are not as widespread as they were in the lead-up to the 2008 crash. 3. Higher home equity. Homeowners today generally have higher levels of equity in their homes than they did in the 2008 crash. This means that they are less likely to walk away from their mortgages in the event of a downturn. 4. Different economic conditions. The current housing market is being driven in part by low interest rates and a surge in demand for more space due to the pandemic. These conditions are different from the factors that led to the 2008 crash, which include risky lending practices and a housing market that was overbuilt and overpriced. While there are certainly differences between the housing market today and the conditions that led to the 2008 crash, it is still important to keep an eye on the market and approach it with caution. It is possible that a correction could occur at some point. What is the significance of bank failure? Silicon Valley Bank, a California-based bank, failed and it was taken over by regulators. This failure has raised concerns about the impact on mortgages and the broader housing market. Silicon Valley Bank was predominantly focused on providing loans to technology startups, but it also offered mortgages to high net worth individuals. While the number of mortgages that Silicon Valley held was relatively small, there are concerns that the bank's failure could have ripple effects on the broader housing market. One potential impact of the bank's failure is that it could make it more difficult for high net worth individuals to secure mortgages. If other lenders are hesitant to take on the risks of these loans, it could lead to tightening of lending standards in this market segment. Other potential impact is that the bank's failure could lead to a reduction in the overall supply of mortgages. If other lenders become more risk-averse in the wake of this failure, they may be less likely to offer mortgages to individuals who don't meet these strict lending criteria. This could lead to a reduction in home buying activities, which could in turn put downward pressure on home prices. It's worth noting, however, that the impact of Silicon Valley Bank's failure on the broader housing market is still unclear. While there are certainly concerns about this potential impact, the failure of this bank is unlikely to cause a widespread crisis in the housing market. It is important for homeowners and investors to keep an eye on developments in the mortgage market and approach it with caution. Are we heading for a recession? The US economy has experienced periods of growth and recessions throughout its history. While predicting recession is difficult, there are several factors that could contribute to the potential economic downturn. One factor that could cause the recession is a concentration in consumer spending. Consumer spending accounts for a significant portion of the US economy, and if consumers begin to cut back on their spending due to the lack of confidence in the economy or increased financial pressure, this could lead to a decrease in demand for goods and services, which in turn could lead to a recession. Another potential factor is a decrease in business investment. If businesses become less optimistic about the economic outlook and start to cut back on investment in new equipment, technology or other areas, this could lead to a decline in overall economic activity, which could contribute to a recession. Changes in government policies or external events could also contribute to a recession. For example, a sudden increase in tariff or a major international conflict could disrupt trade and lead to a slowdown in the global economy, which could have a ripple effect on the US economy. Finally, a financial crisis or housing market crash could also lead to a recession. The 2008 financial crisis, for example, was caused in part by the collapse of the housing market and the subsequent impact on the banking and financial sector. While it is impossible to predict the exact cause of the recession, it is important for policymakers and investors to monitor economic indicators and be prepared to take action if necessary. Maintaining a stable and diverse economy and implementing policies to support consumer and business confidence can help mitigate the impact of potential economic downturns. What conditions could lead to a housing market crash or a housing bubble burst? The housing market is an important sector of the economy, and a housing market crash or bubble burst can have far-reaching consequences. While predicting the exact condition that could lead to a crash or bubble burst is difficult, there are several factors that could contribute to these events. One factor is an oversupply of housing. If there are too many homes available on the market, this could lead to a decline in prices, which could trigger a housing market crash. Similarly, if demand for housing decreases due to economic factors, such as a job loss or a recession, this could lead to a decrease in price and contribute to the potential bubble burst. Another factor is a sudden increase in interest rates. If mortgage rates rise sharply, this could make it more difficult for people to afford homes, which could lead to a decrease in demand and a subsequent decrease in prices. Similarly, if people have taken out adjustable rate mortgages or other types of loans that are sensitive to interest rates, an increase in rates could lead to higher mortgage payments and potential defaults, which could trigger a housing market crash. External events such as natural disaster or global economic downturn could also contribute to a housing market crash or bubble burst. For example, the 2008 financial crisis was triggered in part by the collapse of the housing market and the subsequent impact on the banking and financial sector. Finally, speculation and overinvestment in the housing market could also contribute to a housing bubble. If people begin to buy homes primarily as investment or for other speculative purposes, this could lead to an unsustainable increase in prices that is not supported by the underlying fundamentals of the market. While it is difficult to predict when or if a housing market crash or bubble burst will occur, it is important for policymakers and investors to monitor economic indicators and be prepared to take action if necessary. Maintaining a stable and diverse economy, implementing policies to support affordable housing, and promoting responsible lending practices can help mitigate the impact of potential housing market downturn. According to experts, is there a possibility that prices could further decline? The housing market has been in a state of flux over the past 5 years. With prices fluctuating and uncertainty clouding the future of the market. While there have been some signs of recovery in recent months, experts are warning that prices could fall even further. There are several factors contributing to this prediction. First and foremost, the COVID-19 pandemic has a significant impact on the economy and the housing market. As businesses shut down and people lose their jobs, demand for housing decreased, leading to a decline in prices. While the market has rebounded somewhat in recent months, the threat of another wave of pandemic or other external factors could cause prices to decline further. Another factor is the rise in interest rates. While rates remain historically low, they have been slowly increasing over the past few years. As rates continue to rise, it could make it more difficult for people to afford homes, leading to a decrease in demand and a subsequent decrease in prices. Additionally, there is concern about overvaluation in certain markets. In some areas, prices have risen rapidly, leading some experts to question whether these increases are sustainable. If prices in these markets fall, it could have a ripple effect on the housing market as a whole. Finally, there is an issue of affordability. While low interest rates have made it easier for some people to buy homes, the overall affordability of housing remains uncertain. Wages have not kept pace with housing costs, and many people are finding it difficult to save for a down payment or to qualify for a mortgage. As a result, demand could continue to decrease, leading to a decline in price. Despite these concerns, there are some who remain optimistic about the future of the housing market. Some experts believe that the market will stabilize in the coming years as the economy recovers and demand returns. Others point to the continued growth of certain markets, particularly in the tech industry, as a sign of strength in the market. Ultimately, the future of the housing market is uncertain. While experts predict that the price could fall further, there are many factors at play, and it is impossible to predict the future with certainty. Home buyers and sellers should remain cautious and informed, and work closely with their real estate agent to navigate the current market conditions. In conclusion, as the US property market continues to experience unprecedented growth, there are concerns that this may lead to a property crash. While there is no crystal ball to predict the future, it is important to analyze the factors that could contribute to such an event. One major concern is the potential for an economic downturn or recession, which could lead to a decrease in demand for property and a subsequent drop in price. Additionally, rising interest rates could make mortgages less affordable, further reducing demand. However, it is important to note that the US property market is not monolithic, and there are significant regional differences that could impact the likelihood of a property crash. Additionally, the US government has taken measures to regulate the mortgage industries and prevent the repeat of the 2008 financial crisis. While there are legitimate concerns about a potential property crash, it is impossible to predict the future with certainty. It is important for both investors and homebuyers to carefully consider the risks and benefits of any property investment and to take long-term perspective when making financial decisions. Thank you for making it to the end of this segment. If you enjoyed this content, please hit the like and subscribe button